Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, also known as the 27th best investing channel in the tri-state area according to my uncle, and that's high praise, so keep watching guys. Today I thought it would be fun to be a bit transparent and show one of my portfolios that I keep on M1 Finance, well, two of my portfolios. I am a long-term investor, so these are long-term holds. The majority of my money is in boring old index funds, 401k, IRA, all of that good stuff. But I do have some individual holdings on the side. There's some SPACs in another account. But with M1 Finance, what I've basically done is I've created these two portfolios that I have and have had since 2019, I believe. I really only started tracking performance of these in around 2020. And I thought I'd share some of that with you because it'd be fun and it'd be transparent, and I can track this on this channel and maybe do monthly updates on these two portfolios and share the spreadsheet that I have that keeps track of how this is performing as the S&P 500, show you guys the types of trades I'm making, what I'm adding to the portfolio, what I'm removing to the portfolio. So these two portfolios are on two separate strategies. One is a growth industry portfolio. It holds long-term companies that I believe will exceed the market in terms of growth and their growth potential. They've done very, very well in the last year and a half. Ever since the pandemic began, they've outperformed the market in a big way and have been the reason why I've really done well against the market in this period, even though it's a small amount of money and the difference isn't as stark because it's a small amount of money, and even 10% outperformance on $80,000 is only maybe $8,000, so not a huge amount, but in the grand scheme of things, it's still nice and it's still what you want to do. And then the other portfolio is a dividend Aristocrat-based portfolio. This is a dividend growth ideology that says, hey, dividend growth outperforms the market in the long run. It might not be doing well right now because growth is doing so well and money is relatively easy. You can put your money into crypto and do well. You can put your money into growth players and do well. You can put your money into anything these days and do well. Although this is being made on the morning of 9/20, and I know the stock market is down quite a bit, so I'm sure the portfolios will look a lot lower when the market actually opens. But for now, this is what we're looking at. So the growth industry portfolio, like I said, long-term growth names. You can see some of the holdings here, and I will share a spreadsheet in the comments down below that kind of breaks out all of the slices, and in future videos I'll go over these slices in more detail, but you can look at them yourselves. But you can kind of see it. You can see the holdings here. You've got Amazon, you've got Microsoft, you got Google, Apple, Nvidia, Shopify, a lot of these players that are doing well in recent times, and also I think will do well going into the future. Mercado Libre, Cloudflare, Zotis, Tesla is in there, Activision, Blizzard, etc. Etsy. Biggest performers in this portfolio is Tesla. Freshbet, surprisingly, Trupanion, Square, people love their pets, have been big winners during the pandemics. Laggards in this, Chewy, small position, very small position, but they've been doing poorly. And Vitae, CRISPR, Digital Turbine, which I actually think is a really good deal right now. Roku, which I think is an okay deal. So I'm surprised that I bought it this high, but it's sort of back into a spot where I think it's a pretty reasonable deal. I do like the Roku ecosystem, but again, you can look at these portfolios yourselves in the link down below. Then we'll look at the Dividend Aristocrats portfolio. These are companies in the S&P 500, and I think I've made a post on my blog about this before. I'll link it in the description down below. Companies in the S&P 500 that have not only paid but also raised their dividend every year for at least 25 years. And historically, this portfolio has outperformed the S&P 500. It has done better in times of strife and times of market turbulence. So if you're worried that, hey, maybe the market is overpriced, this is certainly not a safe haven, but a safer haven. These stocks will still lose 20 to 30 to 40% if a market crash happens, but they'll do better than a non-dividend payer, because when a market crash happens, people tend to move towards safety and away from speculation. Growth is more speculative. Dividend growers, dividend payers are more safe. So if you look at the holdings in this portfolio, and this is nothing special, this is more of a more of a passive investment than the other one. This sort of follows the Dividend Aristocrat Index, which is an index that is kept for all of the companies that I mentioned. Biggest returners here: Albemarle, Target, So companies you would know: Lowe's, T. Rowe Price, Sherwin-Williams, and big as laggards here: Atmos, AT&T, Clorox, Hormel, WF Corp, etc. So how have these two portfolios done? And again, I'll do more videos in the future about what they're about and dive into the details of the companies they're in. But like I said, you can look at this spreadsheet here, which I will share in the description down below for links to the portfolios and all of that stuff. So I only started tracking performance at the beginning of 2020, and you can kind of see that initially there was about even performance, but then once the dip happened, once the pandemic dip happened in March, I started to outperform the market, mainly driven by that growth portfolio doing really well, and that outperformance has continued up until today, where I basically started at even at 20,000. I'm ahead about $7,000 between then and now. Hard to track some of this stuff. This might be a bit away because I have to account for every contribution I made and kind of equalize that against the contribution to the S&P 500, account for dividends, account for all of that stuff. So I've done my best here, and I will continue to do my best. But as you can see, I'm doing okay with this portfolio, and this is the result you want to see if you're actively managing your portfolio in any fashion. The reason I don't do it across the board is because I think it's just difficult to beat the market across a long period of time. And while I put aside, maybe 20% of my money for active bets, stuff like this, stuff like SPACs, etc. The other stuff is just in index funds because it's so much simpler. I have to do potentially all of this work and maybe beat the market by a couple percent. It's worth it when you do, and it's certainly easy to do now. Like within this portfolio, I've done pretty well. Within my other portfolio, where it's just SPACs and other nonsense individual holdings, I've done really, really well because it's been super, super easy if you didn't get too greedy within this market to just make a lot of money. When SPACs were popping, you could make 30 to 40% on nothing. It was just absolutely ridiculous. That market has died now, or sort of died. There's still some pump and dump / squeeze schemes that are going on there, and I'm moving away from that space and kind of looking for my next plan of attack. But with this is more of a long-term perspective where you're not seeking short-term returns, because that's more of a form of gambling than it is investing, and you will get burned whenever a market correction happens. And whether that's happening now, because the last couple of weeks have been relatively muted or negative, and you've got a downturn today. Let's see what the pre-market looks like. Down about 2%. Whether this Chinese Evergrande thing is an issue, and if you look at my latest move, my only move in a decent period of time, I actually sold my Alibaba holdings in August. I think they're down about 20 to 30% since then. JD's actually been relatively stable, but I just said, hey, these Chinese stocks, they're just too much for me. I don't know what the government's going to do there. I do think the companies certainly earn a lot of money. They're fairly valued on paper, but what's going on with the government is a question mark that I can't control for. And if I'm looking 5 to 10 years out, I don't know what that means for these companies. So I was just like, I'm out. And I could certainly see myself going back into a stock like Alibaba in the future. I also like Tencent, companies like that, the big ones in the space. But I would have to have more clarity around what's going on there. And you can kind of see where that money went. Amazon, Apple, C, which is probably one of my favorite stocks. If you're investing in Asia, Southeast Asia is a good spot if China is no longer an option for you for one reason or another. A lot of other stocks there. So good performance here. Growth portfolio. You can kind of see the breakout of each portfolio here. You can see it for yourself. It's broken out into various industries. You've got AI, cloud, health, technology, just generic technology, e-commerce, fintech, entertainment, random industries, which is kind of a catch-all for companies that I might not be able to get a full position in some of the other slices, which is what M1 Finance calls each individual slice of the pie of the portfolio. Then you've got pets and animals and autonomous vehicles. The why of growth investing, because when the market is doing well and in the very, very long run, growth investing just performs very well. I didn't track out individual bucket performance until kind of the May to July frame in 2020. But if I account for that, the portfolio went from 36,000 to 80,000, inclusive of the Dividend Aristocrats. If it was just in growth, that number would have been 86,000. And if it was just in the S&P 500, that number would have been at 79,000. And again, starting point is slightly different here. So the numbers in the beginning are slightly different. Dividend risk. So that's the why of growth investing, right? You're buying into companies that have the potential to beat the market in the long run, because the end result of investing returns is how have earnings grown and how has the market valued those earnings, right? You're going to get earnings growth, and that's going to drive price changes, which is going to drive good returns potentially. And you're going to get multiple expansion or multiple shrinking, right? And in the last couple of years, growth has been favored because not only have earnings grown faster than the S&P 500, multiples have also expanded faster than the S&P 500. So while that's been good, it also makes being a growth investor right now harder because multiples are so high, right? Multiples, whether it's earnings multiples, free cash flow yield multiples, sales multiples are way up there. So if a correction does happen, I do feel like growth is going to be a lot more impacted than some of these other areas, whether it's value, whether it's dividend payers, whether it's dividend growers. And you'll probably see that. Now, naturally, some companies are kind of immune to that. You know, if I look at Amazon, am I worried that they're going to correct? Sure. But am I worried that in 10 years they're going to be still correcting? No, because Amazon is a behemoth. You know, same with Microsoft. That's why when you look at this portfolio, it's very much right now top heavy, in that I have the majority of my large investments in companies that I think are going to be able to weather a storm really well, e-commerce plays that are very much internet centric, etc. And those I think are going to do well. Even entertainment's going to do well. You know, a lot of stuff that doesn't depend on the economy really being amazing. It could still do well when an economy kind of falters. And you saw that when the pandemic shutdowns happened. All of these stocks did very well because people were like, well, I could just spend time on the internet. I have to use the internet. I have to buy stuff. I can buy stuff on the internet, etc. So that's why I like a lot of these names. And that's why I feel comfortable still investing in them even today. However, you'll see that in the last couple of months, there haven't been too many buys. You know, there was a buy in August, but since then, nothing, because I just felt like the market was a bit overheated. And I was like, well, I maybe want to return to a spot where I have a little bit more cash to invest. And I did that in the last couple of weeks to months. And now I'm in a spot where, hey, maybe if the market corrects, I have some cash on the side, which is risky because cash is crap if inflation's a thing and stocks keep going up. But, you know, I do have a little idea within my portfolio that I can hold up to 10% max of my portfolio total as cash. That means I'm never selling it all. But when I feel like things are a bit frothy, when I feel uncomfortable in investing, I can just sell a thing or two and have some cash on the side up to a 10% max within my asset allocation guideline. So that's where I am now. I'm not close to 10%, but I'm somewhere between 0 and 10%. Whereas, you know, a couple of months ago, I was almost at 0 when things were really looking pretty good. So that's growth. That's where I'm sitting with growth. Then we've got the Dividend Aristocrats, and the portfolio's there. I did a blog post on my blog where I kind of track some of my personal finances. I'll link you to that within the portfolio and also in the description down below. But the why of dividend growers is that they do well across a long period of time. And this is some slides I found from dividendgrowthinvestor.com. I think this is a guy that does a lot of stuff about dividend growth. Cool blog, you know. And the idea is that, hey, if you're a dividend grower and even a dividend payer, you're going to do well across a long period of time. And the reason for that is when things get bad, these stocks do less bad. They still do bad, but they do less bad. And also the nice thing about dividend growth stocks for a lot of investors is that they stop you from selling when you might not, or when you shouldn't want to sell, right? If the stock market drops 30 to 40%, that's when you should be buying, not when you should be selling. With growth names that don't give you a dividend, that can be hard. However, with dividend growers, dividend payers, you know, if you're getting a 2 to 3% yield and getting more shares at a lower price, maybe you're like, hey, maybe I can just get more yield now and help myself in the future. And if you can stop yourself from selling at an inopportune time, that can be better than beating the market. Because if you are beating the market for 3 years, then the stock market crashes and you start trailing the market and you lose 40% of your growth, 50% of your growth, or you go back to losing money and you sell at that point, what's been the point of it all, right? Investing is a long-term game, and dividend growth stocks, dividend paying stocks can help you do that. So if you look at this slide from Ned Davis Research here as of February 2021, so this is inclusive of 2020 results, S&P 500, an equal weighted index, basically took your $100 invested in 1973 and took it up to 3.7K. Very good. But if you look at dividend payers, that same number became almost 7,000. And then dividend growers and initiators, companies that grew their dividend or started to pay a dividend, is up to 11,000, right? And then no change in dividend policy lags the market. Dividend non-payers, companies that didn't pay a dividend at all, lags the market quite a bit. And then dividend cutters or eliminators, companies that cut their dividend, which kind of shows you that they're not doing well financially, it actually lost you money across that long a period of time. And that probably includes a lot of companies that went out of business, so it's not really fair. And then if you just look at the dividend aristocrats themselves versus the S&P 500, this started in 1989. Big outperformance here, $100 invested took you to almost 3,500 with the aristocrats, just north of 2,100 with the S&P 500. And again, that number tends to lag when the market is hot. You can kind of see here that the S&P 500 was doing a lot better during the bull market of the 2000s. Then the tech crash came and these things did really poorly. Then the 2008 crash came and again, lag there, and kind of catching up here as the last couple of years progressed and technology became more apparent as a use case and a long-term investment case. The risk with this portfolio is that these are companies that have raised and paid their dividend for 25 plus years. It does exclude a lot of the big tech names. So, you're not going to have Microsoft in here. You're not going to have some of the new hot tech plays, whether it's Amazon, whatever. Those either don't pay a dividend now or just haven't been around for 25 years or haven't had the time to raise a dividend 25 years in a row. So some of these names are kind of old school. You're investing in companies that you may think are dull and dead, etc. And maybe that's a negative, but maybe that's a positive. Sometimes dull and boring stocks are just what you need in a market like this when things are frothy, when things are expensive. And that's kind of what I feel is the case today. And I've probably put a bit more money into this portfolio in the last 4 to 6 months than I have in the growth portfolio, because I felt like, hey, if things are going to turn, which they may, I do like the idea of being in these lower multiple stocks that pay a dividend, that have grown their dividend, that have shown they can weather a negative market sentiment better, that can weather negative market conditions better. So those are the ideas behind the two portfolios. Right as of today, I'm sitting at $80,000. We'll do another update in a month or two. I'll try to do this relatively regularly. Let me know what you guys think about this video. I've also got another slide here that says dividends by month. You can kind of see, well, the nice thing about dividend growth, like I mentioned, is you're getting cash all the time. I've gone from $6.18 to $170.19 to $634 in 2020 and already at $588 in 2021 through 8 months through August. So I've got 4 months left. I'll easily beat 2020 results. You can kind of see the big growth year over year here as I put more money, as dividends grow, etc. And then I'll track any portfolio moves I may make off cycle between making videos on this slide here if you want to save this and add it to your favorites. Again, you can always check out the portfolios here. If you click on this, it'll take you to a link that'll show you the portfolio and it'll show you portfolio results. You can kind of see, hey, we've done, 3 years, 205% return, 1 year, 65% return. Some of these pies can be a bit iffy because if I added a stock that IPO'd within the last 6 months, for example, it'll only show 6 months of returns. Sometimes they get a bit errored out if there's, if you click on a portfolio and it only shows returns for like a month, even though it's all mature companies. I don't know why that happens. It's just a quirk with M1 Finance. But other than that, I think this is going to be a cool series where I can share with you guys how I'm doing on this portfolio and kind of talk you through the moves I'm making. And then these are all relatively mature companies for the most part. Not a lot of IPOs in here, not a lot of SPACs in here. I do that in separate portfolios where I just trade individual stocks. And at the end of the day, I keep most of my money in index funds, and I generally recommend anybody who asks me which should I put my money into, index funds. You know, this is just for fun. I do spend a decent amount of time doing research on some of these names, so keep that in mind if you're wanting to invest for yourself. You can certainly invest in some of these pies, but as always, please remember investing comes with risk of loss. You should talk to a qualified financial advisor before you make those investments. I am not that. However, you know, it'll be a fun little series to follow along. So hit the like button if you like it. Hit the subscribe button if you like it as well. Let me know what you guys think. Let me know if you want to see more videos like this. Let me know if you want to know more about any of these specific portfolios and why certain stocks are included. You know, I think autonomous vehicles is one that'll have people scratching their heads like, why is Apple in there, etc. There's just some random companies and random slices because before I created this random industry spot, I didn't have a place to put certain stocks that I wanted to own more of within the portfolio, and I was limited by the target numbers of these pies. M1 Finance won't invest more than the target percentage, so if that pie performs well, you can't buy any more. That's one limitation, but it does make it easier to invest in a way that just allows you to send money into portfolios that are underweight. And that's kind of what I like about it, why I use it. I'll leave a link, an affiliate link. I am an affiliate with M1 Finance, so I'll leave an affiliate link down below if you are interested in joining M1 Finance. But other than that, this is it. Let me know what you guys thought about this video. I'll upload it today, and good luck in the market. Thanks. Let's see how the market is before we actually end the video now that the market is open. It's still showing. Okay, it's down about 1.5%. So, good luck, guys. Stay strong, keep investing. Remember, it's a long-term game, and thanks for watching.